first rates any second now will just come up on your screen. And there we go. First rates, I'll let the screen do all the talking here right now. And the first rates are 28 points down for the Nifty. We are starting with a positive market breadth. It's pretty much even Steven, and you've got a lot of green actually in real estate, a lot of green in pharmaceutical. There is a lot of green across the board, if I may say so, in terms of where directionally the market breadth is moving. Now, what are the big news makers? Yes Bank up 0.5%. You've got not too many newsmakers actually. Let's look at Maruti and Aditya Birla Capital, because those are two stocks where brokerages have really initiated a buy. HDFC Bank, big volume there, but no big change in price action. HDFC TCS, big volume there, no change in price action. Cochin Shipyard, volume there, but again no price action. ABB, volume there, no price action. Very few names are really, popping up in terms of any steep appreciation. Century Textile, news driven, and then there is constructive price action once again in Jupiter Wagons, which has got to do with railway and wagon manufacturing.
Okay, a couple of other names which are in focus then this morning. Let's see what SBI Cards is up to. Remember, we just flagged off the total spends for credit cards has grown nearly about 3% month on month versus 2.7% month on month for the sector. SBI Cards holds up 1% as we speak right now. Century Textiles, wherein Birla Trimaya Phase 1, 100% has been sold out within a span of just 36 hours. That stock gaps up 3.25% as we speak right now. Aditya Birla Capital, wherein Jefferies has initiated a buy, target price of 215. Eicher Motors, active stock from yesterday. Jefferies maintained a buy, hiked the target price to 41.50. Marginal follow through on that stock. They signed as well, wherein Morgan Stanley has upgraded the stock now to an overweight, up the target price to 2,000 rupees from the earlier 1550. And then Shyam Metalics as well, which has announced its entry into energy storage sector. That stock should be seeing a move 0.5% higher as we speak right now. Suzlon, Dilip Shanghvi and Associates have terminated the Feb 2020 shareholders agreement. That stock is down 2.5% right now. And then Tech Mahindra, wherein Morgan Stanley has downgraded the stock now to an underweight and has hiked the target price, however, to 12.10 from the earlier 1,060. So these are a couple of stocks which are in focus this morning. Besides that, I just want to revisit what Voltamp as well is up to, wherein the promoters are looking to sell a 12% stake at 46.33 via a block. This happened yesterday, wherein Oxbow and Kotak Mutual Fund have been buyers here. There's also, Borosil Renewables that also has, quashed the Bombay High Court tax demand notice. So this is one stock that you may want to look out for. There's as well. News just came out that MSPL and 20L are looking to sell the Sustainable Energy Infra Trust units up to about 900 crore rupees via an OFS flat for M&M as we speak right now. And then Adani Ports as well, which has commenced the cash tender offer to buy back about $195 million of 2024 bonds. These are a couple of stocks which are in focus. There's, by the way, Pratap Snacks as well, wherein the GST authorities have conducted a search and seizure at their manufacturing units in Bangalore. So these are a couple of stocks which are on our radar. But pretty much a no-go for the index. It started off very quiet. 19,629 is where we're currently at. Idea, Dixon, Colgate, these were your big movers yesterday. So just want to revisit some of these names. Today, of course, it's all about Individuals Housing. Cipla, which is holding up 1%. Manappuram is looking good by about 1%. Granules is up 1.25%. And AB Capital is your biggest mover with that 1.7% move. By the way, you may also want to look out for Vedanta. That's gapped down this morning. There's a Moody's downgrade of the corporate family ratings on Vedanta Resources. That stock is down 4.5% on the futures, 4% lower on the spot market. Kunal, what trades look interesting?
So yeah, MCX is the stock which I would look to trade in the open. That's a very attractive chart. 2 days back, we'd seen a price volume breakout, and now the stock is back towards that 1900 level. So attractive risk reward to enter the stock at current levels.
Right, Naresh, what about your first trades?
So it matches the same one, MCX, one of the few stocks which has given a good breakout and holding on in the last 2 sessions.
All right, there you have it. That's MCX. It clearly seems to be a consensus buy from both of our chartists. Let's bring on board then Mahesh Patil. He's joining in, CIO, Aditya Birla Sun Life AMC. Hi, thanks so much for taking time out, Mahesh. Let's get in a sense as to what you're making of the fairly fragile global setup currently. Do you believe that if we were to see, the undertone of the market back home changing, that would largely be led by global events?
Yeah, good morning. So, yeah, I think right. I think in the last few weeks, we have seen that the outlook on the global has kind of deteriorated, some kind of a risk off. Again, primarily coming in from the fact that rates hike. Okay, there could be, one more rate hike, and interest rates still probably going up. So the risk to the US global markets, and especially the US, is very much there. Also, while up till now we've seen that the outlook on growth has been fairly stable, but I think if rates continue to remain higher for longer, and that's what the outlook looks like, I think you could see some downgrades, to earnings growth globally, specifically coming into the next calendar year. So I think clearly, I think the risk clearly looks from the global side, and we've seen also commodity prices, especially oil, has in this context has moved up. So that also poses some additional risk, especially from the Indian point of view. But clearly, I think there is some amount of caution over here, and it looks to be that global markets is in a correction phase.
When do you think it will start impacting India? Because the bond yields are at 4.5%, 5%. Some would argue and say that why invest in India at all? I mean, you're taking underlying risk where you're getting 5% or short return in US debt.
Yeah, so I think you're right. I think the yields there are attractive, and in fact, it's a good time to actually be launching a fund actually to invest into the US bonds, right? Because that the risk reward does look attractive. But again, it's a question about really the opportunity cost, right? I mean, yeah, you can play that rate, over the medium term, but I think money which will come into India would come in slightly from a longer term perspective. I think the fact is that in India, despite all the concerns, global concerns, I think we are still looking at a fairly reasonable kind of a growth outlook. Okay, we're not seeing any major challenges over there. Earnings growth also would be in the mid-teens, which is fairly good. So I think given that, and also I think the runway of growth for India, looks to be much better. I mean, India offers the best kind of a market where you could see that runway of growth lasting for, say, many years. So I think that is what will draw global investors. But in the short term, I would agree. Because of, and that's what you've seen in the last couple of weeks, or rather full this month till date, we have seen the FI outflows have been negative. So I think that trend can continue for some time, but long-term money, I think, would look to buy into the dips.
Right. Mahesh, in your portfolios, what is it that you've done from when we hit that all-time peak, pretty much start of the month, to the way we've eased off from there now, about a 3.5% dip just at an index level?
So, slightly trying to be a bit cautious. So, we have seen a sharp rally in many stocks in the last 6 to 8 months. So, wherever stock, and again, some of them have driven purely because of liquidity reasons, not necessarily any fundamental change in view. So, booking some gains over there, trying to trim some of the exposures there where the run-up has been too sharp and, say, beyond our comfort levels. Apart from that, I think more recently, I think the mix towards mid-cap and small-cap in the portfolio, trying to cut down a bit, again, depending on the fund mandate, and more towards large-cap, where the risk-reward looks to be slightly better than, say, in the mid and small-cap. Though I would say the mid and small-cap from a, say, medium long-term perspective still looks good, but more stock-specific. And also probably some of the global plays, right, where the outlook, we have seen some rally again in the global stock because the global growth numbers got upgraded last month. But again, one would still be cautious over there. So some of the global linked sectors which have rallied recently, I think we're trying to take some gains over there. But and then trying to raise some amount of cash, but not too much, because we don't see that it's best time to really time the market over here, because our outlook on the market is still fairly positive from a medium-term perspective.
Okay. Mahesh, why are banks not participating?
Yeah, so that's been some kind of because banks, if you look at in terms of earnings growth is fairly stable. I mean, we don't see any major setbacks over there. Also, the fact that interest rates are going to remain higher for longer, that means the concern which was there on the banking stocks because of when rate cut happens, you would probably see a NIM compression. So that is not likely to happen soon. So yeah, I think it's probably to do with the high ownership which is there, and especially not only domestic but for FIs also, and some of the leading banks, right, where we've seen the management change. I mean, the merger issues which is there. We've seen large amount of selling over there. So I think it's because of primarily being overowned and the fact that the best in terms of the interest in NIM margins is behind us. But that doesn't mean that the banks would see any major cut in earnings. They look fairly steady, and valuations are fairly okay. I mean, they are probably in line with the long-term average or slightly below that. So yeah, so I think it's more about sector rotation. I think other sectors where the growth outlook looks to be better, I think money has moved over there. But I would say the banks look fairly stable here. I mean, and also I think within the banks itself, we've seen some movement towards NBFCs, right? In the last 3 months, where the growth has been much better, and now in the margin expansion, okay, could likely play out as rates come down over there.
Are you being very selective when it comes to IT?
Yeah, so in the IT sector, again, good bounce back we've seen in the last couple of months. And while a lot of the large IT companies have been seeing good deal wins in the last quarter, and that has given some hope that while you might see next 1 or 2 quarters, which could be weaker, but I think next year, again, there could be some bounce back in terms of the growth looking at the deal pipeline. And also rupee has slightly been depreciating more. So that's the reason why we've seen the IT sector do well. But again, within IT, I would agree that one has to look at companies which have got better execution capabilities or executing much better. Also, they're mixed in terms of which segments they are catering to, right? I think that will drive I mean, you will see far more differentiation in terms of growth for IT sector. There'll be few companies which will be growing at around 12 to 15%. Others will grow at around, say, 5% or so. I think so in that scenario, I think it will be important to really be more stock specific because you will see the tailwind across the board.
0.5% of Aurobindo Pharma, some of the pharma names are doing rather well for themselves. So Mahesh, what is the tactical trade for next 1 year or so? I mean, a year ago it was banks, it was buy banks, avoid IT. Suddenly banks are underperforming, IT is coming back. While the macros are telling us that banks should do well, IT should do badly. So where do you think there's the interplay of both tactical as well as structural?
So I would say that, see, I think India growth, okay, and especially what's happening in India, right, both on the manufacturing side, on the investment side, I think that is going to be much more sustainable and structural. And that is driven by multiple factors, right? Both what we are doing internally also and what's happening globally, geopolitically, where countries are trying to move away from China. So I think that story, which has started to play out, I think looks to be far more sustainable. And in that context, and also the fact that we've seen India per consumption side, discretionary consumption has been weak. But India is now reaching a threshold of per capita GDP, which is crossing around $2,500, somewhere near that. So that will mean you will see a secular increase in terms of discretionary spend. And so I think these are some of the sectors where one would take us some more. I would not say tactical is very difficult to say because a lot of things will keep on changing. But these are sectors where one would take a slightly structural view. And any correction in these sectors, whether it is industrials, capital good, power sector itself. Sector also we've seen now, after a long time, we're seeing that the deficits in the power sector could increase. And capex both on the power in the coal as well as renewables is likely to pick up, and that will have a downstream impact on the other suppliers also over there. Even real estate is looking fairly good and steady, despite the fact that interest rates have gone up. Probably cycle has started, and I think there is a reasonably good outlook which is going to be there. And and we see that better execution from the larger players, consolidation industry. So some of these sectors, I think, and all these are more domestic facing. On the global facing, I think IT is a sector where we think that it's a good opportunity to really build exposure, because the current slowdown, what we are seeing, is more because of discretionary spend cuts. And I think the structural story in IT in terms of digital, right, spends toward digital, moving toward digital, and AI now again coming center stage, I think that sector could bounce back going forward. So IT could be a more counter-tactical trade to really buy in this recent slowdown.
Okay. On that note, Mahesh, great to have you on the show. Thank you so much, as always, for taking the time out.
Thank you.
Okay, let's welcome on board now Arun Maheshwari, the Joint MD and CEO at JSW Infrastructure. Remember, it is the first JSW Group IPO in about 13 years. Arun, great to have you today on the show. Good morning, firstly, and what a momentous occasion this is, the first in 13 years from the JSW stable. Tell me, what will you, use the IPO proceeds for?
So the total IPO is for 2,800 crore rupees, out of which 880 crore rupees will go towards the prepayment of the debts. About 1,200 crore rupees would be to the capex, and 700 crore rupees would be towards sustainable general corporate purpose.
Okay, highlight a little bit, about your debt picture right now. What's the debt repayment plan looking like? And if you can just share with us the future net debt to EBITDA guidance that you may have in mind.
So as on 31st March, if I had to look at it, the total net debt was 2,200 crore rupees. And from the IPO proceeds, will be paying close to about 900 crore rupees, and 700 crore rupees, which is general corporate purpose, which will be lying in the books. And there has been a free cash flow, which is generating in the company every month-on-month basis. So post IPO will be net debt free as a company, but there are certain capex more lined up in the future growth plans. However, as a sustainable guidance, if I have to look at it, it would be around close to 2.5 net debt to EBITDA would be the multiple what we are going to give a guidance as a going forward.
What is your existing in-house business? When I say in-house business, how much is coming from the JSW Group per se, and how much is coming from third party?
So I'll just give a perspective to this. 2004 when we started this company, this was largely a captive company, because it was the genesis of the company was to secure the supply chain management of JSW Steel and JSW Energy, and by virtue of that we secured one port terminal in Goa. Thereafter we kept on building the ports, and we kept on realizing, this is a good business to be in. Why don't we start as a separate vertical? For good 14-15 years until 2018, we were handling only group captive cargo. There was no outside cargo. As a matter of fact, in 2019, when we were handling 35 million ton of total cargo, we were doing only 6% outside the group. But when the focus shifted, why we not develop this as a separate terminal in the business per se? FY23, when we ended with 93 million tons of total cargo, we handled 33% outside the group. And in June 23, we handled almost 37% outside the group. So the growth journey continues. The focus area remains, the investment and the ambition to grow this as a very independent separate vertical remains. However, it is important to mention over here that for any port company, you need to have a solid anchor customer. Otherwise, such kind of capex, high capex, because there are entry barriers are very high, the capexes are very high. So you need to have a very solid anchor customer, and what a better combination than if your anchor customer is from your own group, and that too is very growth oriented, be it JSW Steel or cement or power, everybody is growth oriented in the group. So good to have such a solid anchor customer.
So what happens now in terms of new business growth versus in-house business growth? Because they both are very different.
Yeah. So the kind of opportunity what India is offering today to develop this business as an independent vertical is humongous. Like the government of India, which wants to privatize almost all the terminals now, this throws a good opportunity. Almost 50% of India's port capacity today is with government, and they intend to become only the landlord model. What has already been done in JNPT, they want to replicate in almost all the ports now. Assuming, even part of the quantity comes up for auction in another 5, 7, 10 years, this would be good 500-700 million ton of capacity coming up for auction. And where are the major players now? Pan-India, there are a couple of players only available, and the rest all are regional players. So I think we offer a good opportunity. This offers a good opportunity for companies like us who has a good balance sheet, intention to grow, and we have a passion to be in this business now. I think going forward, the way JSW Group is also growing, we will be able to maintain 60-40 or 50-50 in favor of the group going forward from here on.
All right. Can you just break it up for us in terms of, the breakup of your clients, any kind of revenue concentration between anchors and third party?
So since the cargo is almost 63% from the group cargo as on June 23, the revenue is more or less close to about 70% because they are largely from the greenfield ports, the group cargoes. So that's why the revenue-wise they are slightly higher than the other terminals. If I have to look at, most of our terminals are very new and very strategically located. If I have to talk about my coal terminal in Paradip, which is one of the largest coal terminal in India, it is very close to Mahanadi coalfields. So naturally, the customers like all the south customers, all the Gencos, whether it's Tamil Nadu or Andhra or Telangana or Karnataka, they become the natural customers for us. So imagine there has been no new power plant came up in last 2 years, thermal power plant in south of India, and still this is one of the largest terminal of coal running at almost 60% capacity as of today. So this kind of growth opportunities are there because these are strategically located. Even though there is no single big anchor customer other than JSW Group, the number of customers are flowing in just because of that. Similarly, if I have to talk about my iron ore terminal in Paradip, this is the 3rd year of operation and we're running at 100%. There's no need of having a solid anchor customer over there because the location attracts the business in port businesses generally.
What is the outlook when it comes to your overall margins as compared to your peers? Can you just give us some details as well in terms of what the projections are?
So if I have to look at my EBITDA margin, it's close to about 53%. But then I think the industry standard as of now in India is generally about 65% is what is compared with. I would say, our business model is very different. We are 50% on the greenfield port side and 50% on the terminal side. When I talk about terminals are given on the major ports on a PPP model against which the ecosystem is provided by the major ports. And we have to just mechanize, modernize, invest in the equipment. The risks are very minimal. The gestation time is very low. The customer profile is very well known to us. So with this kind of profile, our capexes are very low, against which we have to pay a royalty, and thereby the EBITDAs are less. So our business model is 50% from the greenfield port, 50% from the terminal side. That's why EBITDA margins are towards the lower end if I have to look at as compared to any greenfield port. But if I have to look at my greenfield port alone, it is as comparable to any other greenfield port in India today, close to about 65% margin. But as a group, as a company, we look generally towards the return on capital employed. Our return on capital employed is fairly robust and fairly good. It is close to about 20% as on FY23.
Okay, fair enough. That's the outlook on your overall margin picture. Can you also get us a sense into what the outlook is in terms of your overall capacity, how you plan to grow that, and how you're looking at ramping up your overall capacity plans?
Today, our capacity is about close to 158 million tons. The kind of growth prospects in India, especially when there are hardly any competitor available, a couple of players are there, pan-India. And the opportunity what PPP model provide, the opportunity in the greenfield port, what we are looking at today, and a couple of brownfield expansions, what we are doing today. I think in the last 20 years, when we maintained 22% CAGR on the volume front, the kind of balance sheet what we have today, even though the base volume is high now, I think we would try and maintain the similar kind of CAGR going forward as well.
And what's the outlook in terms of your overall volume picture, how that has shaped up so far, and what is the outlook?
So we started with a small terminal of about 5 million ton in 2004. Today we are 158 million ton. I think the way we are planning out our future growth, I think another 5, 7 or 10 years time, we should be almost double from here on because the kind of growth what we see in India, it's very handsome, very, very good.
All right, good to have you on board. Thanks so much for taking time out and joining in and giving us more perspective on how the business is shaping up, your overall capacity and margin expansion plans. Tell you what, we'll slip into a very short break with news that we're at 19,600. We delve into the outlook within the FMCG sector in greater detail when we return. Thanks for staying on with us. Still tuned into First Trades, and it continues to remain a pretty tempered market at hand. In fact, it's the mid and the small caps as well that are pretty much neck to neck with the frontliners. Just want to identify then some of the stocks that are bucking the general trend or are managing to hold out quite comfortably in the green within the broader universe. Ujjivan Small Finance Bank has perked up a solid 6%. Ditto is the case with an Ujjivan. REC is comfortably in the green, so it's a solid 3% gain that you're seeing on that stock. KSB Palms, Indian Banks, Manappuram Finance, as well as something like AB Capital that we discussed earlier this morning, that's as well has gained about 2% or so. In terms of individual sectors, metals, autos, and even the banks, they're not participating in trade today. It's Pharma and the PSU banks which are taking leadership. So that really seems to be the texture of the market, as we're currently down about 220 odd points when it comes to the Sensex, and for the Nifty, just about holding on to the 19,600 mark. And this is a day prior to expiry. Just want to revisit then some of the newsmakers. Pratap Snacks, what's it up to with respect to the GST authorities conducting a search and seizure, clearly languishing in trade today. You've also got something like a 3i Infotech. It's a 40 crore contract that the company has bagged from Ujjivan SFB, and that stock should be pulled up for you. A 3i Infotech in the spotlight. SBI Cards as well, I reckon, is continuing to hold out well, given that the August spends have risen about 40% or so. So that stock is a buzz. And then we flagged off REC, but there's PNB as well. Remember, there's an MOU between both of these companies. This is to co-finance an infra project debt worth about 55,000 crore rupees over a period of the next 3 years. And Adani Ports as well in the spotlight. They've commenced that cash tender offer to buy back about 195 million of 2024 bonds. So that continues to remain in the news. But let's move right on. And as promised, FMCG is in discussion. Are we going to see the festive fervor aiding rural demand? What is the outlook on inflation hurting the overall consumption space? Sunil Duggal is the former CEO at Dabur, and we've also got Akshay D'Souza, Chief of Growth and Insight at Bizom, now joining in. Thank you so much for taking time out, and would like to get in a sense from you then, Mr. Duggal, first up, as to what the outlook is when it comes to the festive season. Are you sensing that, given that it's a delayed festive season, that some of the concerns when it comes to the high raw material prices or high inflationary concerns could perhaps be assuaged by the strong festive demand?
It doesn't look that way as of now. I think the festive demand could be very, very muted, even though the festive season is a little bit rear-ended at this time. Diwali is around mid-November. But I don't see any triggers to spur demand, particularly in rural. The inflation remains high, and that's going to cut into the consumption basket. The overall sentiment is weak in terms of consumption, with the monsoons being very erratic. And the only trigger could be, extensive government stimulus pre-election, but whether that will really move the needle in terms of demand, particularly rural demand, is yet to be seen. So as far as the staples sector is concerned, I think we are going to see 2-3 quarters, maybe 2 quarters of subdued demand, and after that, things could perk up, leading into the 2024 elections.
Sunil, if I look at some anecdotal data, which is credit card spends, retail credit growth, the kind of indications which we are getting, let's say, from a Maruti in terms of the dispatch numbers, all of them are telling us a very different story. While the rural economy is under stress, it is not that the consumer is shying away. Otherwise, why would retail credit grow? Why would credit card spends go higher? There's something happening in the economy which seems to be very transient, I guess.
Where credit card spends are not material and Maruti caters to a different segment. I'm talking about staples demand, bottom of the pyramid demand, the everyday groceries, etc., etc. And that is one area which I feel that the demand seems to be chugging along in the low single digits. And I don't see any triggers for a revival happening in the next, say, couple of quarters at least. Now, things may be different in the discretionary space, autos, etc. The numbers do look much better there, but that's a different segment, and I don't think the two are correlated.
Akshay, if I could get you in on the discussion, when it comes to pure play FMCG, what's been your observation? Typically, you think, high edible oil prices, high input prices, do they really dampen spirits when it comes to buying FMCG goods? Because some of them are something that you can't do without, irrespective of what the pricing is going to be. Akshay, if you could come in on this one.
Sure. So I think one of the things that you have to actually see from an edible oils is critical to almost a large number of FMCG products as an input cost, right? When I now look at edible oils year on year, we are down 40%, which is great news for almost all FMCG companies. What it means is it gives a lot of these companies the flexibility to now offer greater volume at the same price, and that's what we're seeing happening in many categories. So while we actually now have the run into Diwali, which is in November, I do expect to see a whole lot of activity starting right about now until say the middle of October, in terms of heavy stocking that I will expect to happen at the store, where they will try to capitalize on the Diwali demand, so to speak, the festival demand. But that being said, when I look at all this data, I think one of the things that was a little concerning was the rainfall, which was again very transient in nature. And we were staring at El Nino fears, the whole, the effect possibly of a washed out monsoon. But I think September kind of has eased off some of that fear. And I think when I look at also the export measures, the export control measures, if I can call it that, the government has done on wheat, on rice, also on stocking a lot of edible oil, for the season. I think what it tells me is that the price on these are going to come in control as government releases supply in local market. So I do expect that while August may have been subdued due to maybe the blip of the rain, there definitely could be a boost in demand as we hit the festival in November.
Mr. Duggal, wanted to get in your take because data is indicating that local brands have grown by nearly 13% in terms of volume between last April to this one. Is there actually a space for them in terms of taking on the fight to some of the larger, more well-established companies?
Well, look, that's an indicator of the demand stress. People downtrade to local brands when incomes are squeezed. And that's probably something which is happening now. And typically when incomes are buoyant, the local brands ebb away. So I would take it as one lead indicator of the demand stress. Now, which could turn around, you never know. Edible oils is certainly a benign input cost, but there are many others which are highly inflationary, petroleum now. And so on balance, there is inflation in terms of the margins. Companies are sitting on much higher EBITDAs than they were, let's say, the same period a year ago. How much will they be willing to pass on that is a matter of conjecture. How much will that stir demand is again a matter of conjecture. We could hope for the best. But as far as I'm concerned, the outlook remains subdued. I don't think it's a gloom and doom scenario, but it's certainly not anything to be very excited about.
Sure. Mr. Duggal, you must have seen such cycles many a times, right? When food inflation or agri-inflation does, perk up and does sort of throws off the household budgets, if you will. What's been your reading and understanding of the many decades that you've tracked the sector about how a consumer typically behaves as opposed to, premium products versus mass products versus essentials?
Well, the highly discretionary products, the demand remains unabated, and I think there's enough data to validate that. But it's really the bottom of the pyramid stuff, the everyday staples, which are stressed. And these are very sensitive to price movements and to income levels. So we've seen, a dozen cycles of ebbs and flows, so nothing to get alarmed about. I'm just talking about the near term. The outlook does not seem to indicate any strong revival of demand. I hope I'm wrong, but the festive season would be materially different from what we've seen the last couple of quarters. But I don't see any indicator to validate that particular hypothesis.
Akshay, what about the other end of the spectrum, the ultra luxury, the ultra premium? The data there is very, very encouraging. Do you think that gap, Akshay, between rural versus ultra luxury is going to coexist, Akshay?
Yeah, for sure. So, I mean, I don't really see, inflation really eating into consumption of the ultra luxury products really in the market. Now, even if you look at some of the, FMCG companies who actually work on premium brands, at a certain end, you see that the premium brands continue to grow, whereas at the mass segments is where the challenge really lies. And I think we may be seeing a lot of down trading on the mass segment, but nothing much shifting on the premium end, even from a consumer standpoint. But that ultra luxury segment, I think they are almost inflationary proof. And the fact that you actually now have availability of a much larger set of products within the country, I think it just makes it that much easier for them to procure and kind of grow on that front.
All right. What's the sense that you're getting as well, Akshay, when it comes to looking at the overall volume growth across categories? Are you seeing some specific categories outpacing the others? And if so, which would they be?
So volume growth, I think, critically will, until now, one of the things that we've seen, and I'm looking back again at August data for you to get, because that's the last piece we have, we did see some downgrading for sure. That being said, I think a big driver of volume is going to be the festival, because it's one of the biggest consumption triggers that we have in the year. And with the rainfall, in the backdrop of the rainfall now getting back to normal, while we do have certain crops where the yield is going to be much lesser, especially in rice and so on and so forth, you still think that there may be a volume play in place where people are actually now, from shrinkflation earlier, now they're also looking at increasing pack sizes at the base, which is essentially going to be a volume play. Then I see that happening a lot more in the segment as we kind of build up to the festival.
All right. Appreciate your time, gentlemen. Thank you so much for joining us and giving us an insight as to how things are shaping up within the entire consumption and FMCG space. We'll take a very short break right here on the show. Be right back with the management of KIMS Hospitals when we return.
Okay, as we can see, the pre-open indicative prices for the two new listings, which are set for today, that's Sai Silks, 4% premium is what's the indicative price, and a 15% gap up is what you could expect on Signature Global. We will, of course, mark those rates when the listing happens. But let's now focus on what's really happening within the hospital segment. Where is demand really coming in from? Where are the volumes seeing a bump up? And what's the growth trajectory going forward? We've got with us the chairman at KIMS Hospital, Dr. B. Bhaskar Rao, on the show right now. Dr. Rao, great to have you on the show today. Help us understand what's really happening within the industry right now. Growth is surely there, but is it being led by pricing or is it volumes?
Is both parameters, volume and as well as pricing. The volume is basically because of the aging. A lot of diseases will come in the elderly people. So last 4-5 years, aging is one factor. Second is the post-COVID complications and long-standing diseases. That's why the volume is growing. The second important thing, affordability is also improved because of the post-COVID. A lot of people are going for insurance. Once the insurance is coming up, then everybody is, whatever is small disease that is there, they are trying to go to the hospital and rectify themselves. So that's why the pricing and as well as the volume both are growing simultaneously and parallelly.
There is a lot of PE action happening in the sector. Suddenly, a lot of PE investors are looking at assets, they're turning it around. Big hospitals are consolidating. Mid-tier hospitals are expanding. So why do you have so many different factors at play? Big guys are expanding to small towns. Mid-tier hospitals are getting a lot of PE investors. Where do you think the sector is headed?
So basically what is happening post-COVID, then everybody realized the need of the healthcare in this country, not only in the country, in the world. There are so many states in this country is underpenetrated, not able to cope up the requirement of the patient load, either in the form of government hospitals or private sector hospitals, and the insurance penetration was very low. Now the affordability has increased in all sectors. Like if you talk about the below poverty line, there is a state governments are coming forward with insurance base to support the below poverty line people for their treatments. And at the same time, Ayushman Bharat, the central government has come at least 50 crores of the population, they also insured. So these are all previously inaccessible to the private healthcare. They were used to go only a government sector. Now these are all eligible to go to the tier 1, tier 2, tier 3. Even small nursing homes has been recognized by the Ayushman Bharat. So most of the people, once there is a volume is coming up, the cash flows improves, then the demand is there, so they are planning to expand. All the top players, they are trying to consolidate, taking this as an opportunity. And now with the returns that they are getting, the private equity people are also showing this one is a good sector where they are planning to invest. With these things, there is a good volume growth and there is a scope for the need and there is a demand. There is a gap between the requirement and the demand. So to fulfill all those things, everybody is concentrating on that to see that we can able to more volume and as well as the financial growth will come by doing more and more hospitals. And the ARPOPs are also increasing because of the one factor of the insurance and maybe the cash paying and the affordability. GDP has increased. Ayushman Bharat has come. All multifactorial, the affordability and the accessibility is previously the tier 2, tier 3 in small towns. There was not much of focus. Now because of the Ayushman Bharat, the accessibility is also very good. So that's why they are going, all of them are a cashless service. So more and more people are going to take up their health.
You know, the other thing I also wanted to talk about, Dr. Rao, is how is it that you're expanding? Because we understand that you're in the process yourself of adding about 2,500 beds over the next 3 to 5 years. Tell us what's the timeline for Nashik, for Bangalore and Thane and, you know, the other places we're looking at expanding.
So it's been planned in the last couple of years, maybe finished by next couple of years moving forward. Thane, as we talking about, maybe in the next 12 months, we are going to operationalize. And Nashik will be maybe next 6 months to 9 months time. Nagpur is already running and is ramping up. Sunshine we acquired recently, that is also going very good as we expected. Bangalore once by next 18 months to 24 months, we are going to operationalize. So, and apart from that, we are also planning to do in nearly 1,200 beds in Andhra existing units where this capacity is almost running around 80 plus occupancy rates. So both in Nellore, Ongole, Anantapur, Kurnool, Rajahmundry and Srikakulam, Vizag, all these places we are adding another 1,200 beds where we can able to put the new therapies, mainly focusing on cancer and women and child. Apart from that, existing hospitals, the tertiary care, like high-end like transplants, like liver transplants, kidney transplants, we are planning to do. With that, I think these 1,200 beds will come. In Hyderabad, apart from acquisition of Sunshine, we are planning to do another extra 400 beds we are going to add in Kondapur, which is existing hospital is running around 200 beds with a 92% occupancy. There is a hospital I started about a couple of years back. In that, we are planning to, from subsidiary, because that is the geography that is going to cover. And there is a 92% share in the KIMS listed company. There is another 8 to 9% will be in the local doctors who are working in that company. So with that geography, we are going to invest further. We already invested in one of the healthcare 28%. So there we are going to get another 600 beds. So existing 200 beds, if you take out, then another 400.
Dr. Rao, just stay with us. Lots more to talk about with you, and I'm just going to come back. And there you can see the live visuals from both the NSE and the BSE, where the two listings of the day, that's Sai Silk as well as Signature Global, are listing. Remember, the indicative prices already indicated a premium for both and a bigger one for Signature Global. There you go. It's a 16.5% uptick that Signature Global listed at, and Sensex, which also had a fair amount of interest in the market, that has gapped up about almost 6%. So a premium for both those new listings as we speak. But yes, Dr. Rao, you were telling us, apologies for that interruption, you were telling us about your expansion plans. Please finish your point.
Yeah, see, we want to expand, as I mentioned, in Andhra about 1,200 beds. Outside Andhra and Telangana, we are putting another 2,000 beds, including Nasik, Thane, Bangalore. And also we are doing another 400 beds in Telangana. These are all our expansion plans. All these things are going to happen in the next 24 to 36 months. Start functioning from 12 months onwards. Every 6 months, we'll be keep adding around 200, 300 beds. Within 3 years, we'll be able to ramp up all these 300 beds. Everything is going on track. The other important thing, whatever is the finances that we want to do for this expansion is costing around 200 crores. In 300s, we have all these things we are all doing within our internal accruals and the small debt. The debt, we are not going to go beyond 1:1 EBITDA and debt ratio. With that, we are very, very cautious about our financials, our balance sheet, and we want to create more value for our investors.
So as you expand in terms of the number of beds, where do you think your return on capital, ROCE, will actually settle?
So basically, whatever we have been shown in the last few years, and we would like to achieve the same targets in the moving forward. So definitely we'll achieve that ROE, ROCE of the same levels what we are planning to, we'll continue to maintain that. Maybe sometimes when more capex has come in that 1 or 2 quarters or off quarter, at that time it may little dip, but it will be able to come back to normal.
Last couple of questions. In terms of the health insurance per se, post-COVID, what really has changed for you in terms of that health insurance business or health-related insurance cover coming to hospitals now?
So what is happening during that time, there is everybody has to pay the cash from their out of pocket, which has pinched a lot and is very, very painful also. So during that time, the government has also come, COVID also they cover COVID couch of insurance. Then they realized the value and significance of the insurance with low premium where we can able to get the maximum benefit out of it. Beyond that, most of the public has realized those who are not uninsured, they are planning to insurance. So the penetration of insurance will able to make more affordable to the public. That is one aspect. Second aspect, volume are growing because now with all these things, the aging is increasing. Last 5 years, if you see, in the next few years also, next 5 to 10 years, the aging is a factor now. Once the aging is improves, there is a lot more diseases that is going to become in the world elderly people, like our cancer, the gastric, the cardiac problems, all these issues. So with that, more and more people are more cautious that they are prone for the diseases, they're moving on to the insurance. Once the insurance is there, the affordability and also the paying capacity to the hospitals will be much, much better. That's why the RPOPs and average revenue per bed and all those will improve. So with that, once whatever the capex you put, with that the ROE, ROC is also improves.
Great to have you on the show. Thank you so much for, really flagging off what's happening in the sector and, of course, with Kim's Hospital in particular. Good to speak with you today.
Thank you.
Let's now move on and let's talk about what's been happening with the tire industry. What with the soaring crude prices, rubber prices, and at the same time, not just high input costs, but demand continues to be on an uptick. So let's try and understand what's happening. We've got on board with us Anuj Kathuria, the President India at JK Tyre, joining in on the show right now. Anuj, hi, good morning. Great to have you on the show. Anuj, we all know what's happening with crude oil prices. Internationally, rubber prices as well have been seeing a jump. Tell me firstly, what's happening to your raw material basket cost increase from first quarter up until now?
Yeah, so good morning and thank you for having me on the show. As far as the input material prices are concerned, if you take the quarter one and even what we are seeing in quarter two, they have been largely range bound. There are some commodities where we saw a downward trend continuing from the quarter four of last year. In some commodities, they have been more flattish. Yes, there are indications of the crude oil, but as of now, that has not reflected in our input material costs. But we are watching it very carefully, and we would be kind of keeping those things in mind. But as of now, as I said, all the input material costs, whether it's natural rubber or others, are all range bound.
Does it stand to then impact your EBITDA, gross margins in any which way, or would you say they've actually improved from the first quarter levels?
No, we will be seeing, as of now, quarter one, we saw that our EBITDA levels had improved as compared to the previous quarter. And we expect that the similar trend to continue going forward. There would be, in case there are any major changes, which we do not anticipate as of now, we would have to again take pricing action. When it comes to the OE, most of the OEs, especially in the passenger car segment, we have indexation with the raw material. So that gets taken care of to a large extent. In the replacement market, what we are seeing as of now, we are approaching the festive season. The demand is looking great, especially in both in the passenger car as well as in the commercial vehicles. So once the demand is there, I think so the price levels definitely sustain.
Mr. Kathuria, hi, morning. And you've also been gaining market share in select categories. How are some of the new launches in the PV segment and the new products in various categories? How is that shaping up? And if you can also highlight your foray into the high value EV segment, will that help raise your overall average realizations?
Recently we had announced the passenger car capacity expansion, which we had undertaken in our Banmore plant. That is progressing quite well. With that, we are producing the higher segment, higher rim size tires. The demand for those tires, the premium segment tires, is increasing, especially with the overall passenger vehicle segment moving to more of the SUVs. So the demand for the higher segment tires, especially in the 16-inch and above category, is looking quite robust. Those tires are definitely more profitable, being in the premium segment. So we are making the efforts to move into that segment in a big way. That will definitely help. We had also launched in the quarter four of the last financial year, the Levitas range of tires, which are for the luxury segment, the Levitas Ultra. That also has been very well received in the market. There again, we expect the volumes should pick up going forward, considering the overall population of these luxury cars increasing by the day. So we expect the premiumization, as we call it, to pick up even better in the next few quarters.
Players in your industry have also cut prices of select categories. Do you plan to do the same?
As I mentioned that, this is more of a market tactical play. So this is, I don't read too much into it as of now. So depending on which geography and which region we are talking about, each of the players have their own way forward. We have also been able to launch a few premium segments in the commercial vehicle category. Our extra fuel efficient or the energy saver tires, those have been launched and now available pan-India, both for OEMs as well as in the replacement market. They have been received very well. In fact, some of the responses that we have been receiving of late from the fleet operators is very encouraging. The kind of fuel savings that they are able to get out of these tires is really encouraging, and we expect that these would establish themselves as a winner product in the market. Talking about the EV tires, as you rightly said, we are having a full range. We are market ready. In fact, in some of the segments, especially in the intra-bus segment, intra-city bus segment, where we have, in the places like Delhi or even other cities like Bangalore, most of the buses that are there, the EV buses, do run on our tires. They have been very well received. For the passenger car segment, also we have launched the tires which are made, designed and produced specifically for the EV range of vehicles. Two-wheelers, as we know, is a segment where the EV penetration is the highest. There again, we are working very closely with many of the OEMs, and also our tires are being made available in the replacement market.
The other thing I also wanted to understand, was the expectation of, the replacement demand, and especially ahead of the festive season.
Yeah, so as I mentioned, the replacement demand is quite robust as of now, both in the passenger car segment and even in the commercial vehicle. Though there is a shade, sluggishness in the TBR and the TBB, but that also is not. September generally is a good month, and the demand is again showing up robust. July and August being months where the monsoon is at its peak, definitely the demand is a little sluggish, but we see it coming back once the festive season kicks in.
So just a word on your net debt, because that, as we understand, has reduced by around 25%, right, since FY19. How is it that we should see your debt move in the future quarters and years to come?
So we are, our efforts are on to further deleverage, and we are working on that. There are specific plans, and we would expect that, in the next couple of years, say by FY26, we should see the long-term debt reduced by another 25 to 30%.
How much time? Would you have a timeline target for this debt reduction that you just spoke about?
As I mentioned, we are looking for this debt reduction by FY26.
That one, my bad. FY26. Great. Great to then have you on the show, Mr. Kathuria. Thanks so much for taking the time out.
Thank you very much. Thank you.
Okay, that's JK Tyres not really feeling the heat from the escalation in crude oil prices, or for that matter, rubber prices so far. The debt reduction plan on track. For the index, by the way, we've seen quite a sharp slip down coming in. About a 0.5% downtick is what you've seen. So we are now up the 19,600 mark. And this after 2 days of a nothing sort of move on the index, you finally cracked quite a bit from where we started off in trade. We'll analyze more on the markets. For now, we're going to take a very quick break.